All right, let's go ahead and get started. Thanks again, everybody, for joining in. This is our 2310 monthly educational webcast. We're going to dive into our topic of the month, elections and the market, and isn't different this time. We're going to be exploring just what's coming up over the next few months as it relates to the elections and the markets. Our agenda, kind of the same thing that we do every month here. We're going to spend 23 minutes on the educational topic. Also just touch briefly on latest activity in the markets, key health data and key economic data or key summary of economic data, and then spend 10 minutes of Q&A. I did have a couple questions that were submitted in advance, so really appreciate that, and we'll make sure to hit both of those today. And again, just a reminder, you can use your Q&A function as everybody already has, or a few people already have, to submit questions as we go. So feel free, keep those coming. If it's relevant to what we are discussing, I'll try to hit it as we go. I'll keep my eye on the Q&A over here to my right. And if not, we'll just make sure to address those at the end. So go ahead and use that. So let's get into it. Just a real quick check-in on the markets and some key health data. If you've been paying attention, the markets have sold off a little bit since the beginning of September. So again, just a recap of the year, we were down about 34% from the peak in March. That's a pretty average bear market. Rebounded 60% to the beginning of September. And that was actually a new all-time high in the S&P 500 anyway. And then since then have started to sell off and have a little bit more volatility in the market. So that's where we are. Some of the things that are driving that, obviously, this has been a health crisis this year. The economic challenges that we're facing are driven by the health crisis. And so this is always worth keeping an eye on. And I think, one of the things that the market's paying attention to right now is this data. So as you can see in the panel there, the second panel there, new cases started to come up a bit here in the US of late. This is something in Europe as well. They're starting to see a resurgence of cases. Britain starting to talk about doing some limited lockdowns again. So definitely something that we need to keep an eye on, and something that's driving obviously economic prospects as well. So that's the first thing. In terms of economic data itself, what we've been paying attention to this year is, again, the economic data, is it better or worse than expectations? So this is a really good index that kind of maps that all out. It looks at consensus forecast for the economic data that's coming in, and then looks at the actual data. Is it better or worse than expectations? And so what we've seen basically since the economy started to reopen again is numbers coming in much better than expectations, a really big spike up to around a 280% better level. We've started to see that pull back, which is not surprising. Still, the numbers continue to come in better than expectations, but the last few weeks it started to pull back. Again, not unexpected. As the bar gets higher, it just becomes harder and harder to exceed that bar. But we are starting to see that come back towards the zero line. And that makes sense. I mean, this should be mean reverting. As the data comes in better, expectations get better, and it becomes harder to exceed that. We are still seeing numbers come in better than expectations. Two kind of data points though this week, both on the unemployment numbers, kind of initial claims and then continuing claims, both came in worse than expectations. Not by a lot, but a little bit worse. So that'll obviously bear keeping a watch on. So that's kind of our recap on where we are. Want to spend the bulk of the time today going through markets and elections. Coming up here in basically a month and a half or so, we've got an election coming up that everybody's aware of, and want to provide a little bit of perspective and some thoughts on some investment considerations that we should be paying attention to through this period. So first, want to deal with, the normal kind of the historical context around an election. No matter what, from my vantage point, there's always going to be some uncertainty, some anxiety, some people, fearful or otherwise through an election. So kind of just look at what history has shown through an election. Then spend some time on, it feels different this time. Is it different? And any considerations there. And then, we're going to look at the kind of the normal scenario. We also want to look at this scenario of a disputed election or results that drag out, or a result that we don't know, that kind of the process really drags out. And want to spend some time on what that process is. I think the better we are informed about what's going to happen or what could potentially transpire, the better prepared for that we can be. So I want to spend some time there, and then lastly wrap up with some investment considerations as well. So that's the roadmap, and let's jump into kind of the historical context here. So again, this is normal election going back to 1928, so 90 years of data or so. What you can see is there's no real patterns. We shouldn't behave differently from an investment standpoint in an election year or around an election year. So average return for the stock market's roughly 10% in any given year. The average return in the year after the election historically has been 10% in the election year, which is 2020. It was slightly better, little over 11%. So there's no real pattern here. There's no real way to time it, get into the market before an election and out after the election, or vice versa. No real pattern there. Pretty normal in terms of returns that we've seen in these years. Both in this case, it would be 2020 and 2021 for kind of your average year in the stock market. So no pattern there. The other thing that people look at is which political party is in the White House. Does that make a difference? And it depends the way you cut the data. I mean, there's a bunch of different ways to kind of cut this data. There's a limited number of different presidents, honestly, going back to 1929 that fit the data, and obviously just two parties here. But as you can see here, there's no huge patterns to this either. Average return under any presidential terms about 10%, which you would expect around 10% because that's the average return of the market over time. In terms of one party over the other, I mean, you can see basically the two largest negative returns were under Hoover, 29 to 32. That's the Great Depression and the collapse in 1929. The other major negative period was negative 5% under Bush, which ended in the global financial crisis. So both of those terms being bookended by one of the largest economic depressions or recessions that we've seen. Other than that, the numbers are fairly similar across presidential terms over time. So again, point here is in a normal scenario, really no huge differences between election years or non-election years or party in the White House. Last time we discussed this topic, it was August, I believe, July. We were looking at the conventions coming up, and one of the things we said, hey, if you're curious about watching, one of the things to watch would be what does the market do between the convention and election day. And historically, if the incumbent party is to win, returns over that period have been stronger than if the incumbent party is to lose the election. So last convention this year was the Republican convention on August 24th. So since then, through today, obviously we're not through to election day yet, but markets are down. So S&P 500 index is down 6%. World markets are down about 4%. So interesting. I mean, I'm not going to read too much into this, but obviously if a pattern holds the worst returns over this period, it's telling you something about who would win the next election. So interesting, something maybe to continue watching, but something we brought up last time and worth checking in again this time. In terms of betting odds, actual market where people are putting money to wager on the outcome. Obviously, you can see this has flipped over the course of the year, widened quite considerably through the summer, and has again narrowed again. But Biden is still in the leads in terms of betting polls for who wins the election. So 53 to 46% roughly here, and we'll continue to watch this, update that. It has implications on basically the three scenarios that we could get through the election. So one is status quo. Trump remains in the White House. and Senate remains controlled by Republicans, so kind of no change there. Blue wave, Biden wins the White House and Democrats get control of Congress. And then the gridlock scenario being Biden wins White House, but legislature is still controlled by Republicans. So this is some analysis that was put out through Barron's, and they did some analysis here on what these three scenarios mean, what are the odds of the three scenarios, and different implications. So we're going to get into this a little bit further, especially from a tax perspective, kind of the key differences between the candidates from a tax perspective. But I think from a big picture perspective and market impacts, these are really the three scenarios that we need to concern ourselves with. The key here is, like, as you can see, there's not a huge just in and of itself. Obviously, the economy is going to be a huge factor in what the market does. Health data, how that continues to come in, and the health crisis, getting that resolved. Do we get a vaccine? Things like that. That's going to have a huge impact on the market. The outcome of the election itself, not a huge impact on the market. So status quo, they give 35% odds with the 2% upside for equity markets. That upside comes from the fears that are kind of baked into the market of higher taxes and regulation would subside, and cons would be continued uncertainty around trade policy. Blue wave, a little bit of downside for markets. They're driven by higher taxes and probably higher regulation. Kind of as they outline the pros of this scenario is the campaign messaging isn't policy. So some of these tax proposals that are out there, they probably won't all get approved into law. And the other pro would be some higher spending that gets approved under this scenario, might offset any increase in taxes. The other scenario, the gridlock scenario, actually has the biggest upside for markets. Kind of get a little bit of a mixture of pros and cons here. So lower trade risk with some increased predictability, but potentially some higher regulation as well. So those are the three scenarios kind of in a normal election based on what we have today. And as you can see, again, kind of the conclusion here is there's pros and cons to the different platforms on how they might affect the market and the economy, but no huge upside or downside to either scenario just based on the results of the election. Now, however, obviously we're hearing a lot of comments from just people we talk to every day in the paper that it feels different this time. 2020 has certainly been a different year, unlike any year that probably any of us have lived through. And global pandemic, a lot of civil unrest, economic crisis, elections, very divisive elections. It's been a year unlike others. And so, does that mean this election cycle is going to be a year unlike any others? And, I get the answer is maybe, and it's worth considering. So historically, what we're looking at here are VIX futures. So VIX is the measure of volatility on the market. And historically, what you see here is these lines tend to be upward sloping. So the further you go out into the future, the more volatility or uncertainty that would be expected. So what I've done here is just grab this plot of what is the volatility and how far out are you going for today or this year, and each year going back to 2013 for roughly this date. So around September 21st, pulled this a few days ago. Typically, the further you go out, the more volatility there is. This line at the top is basically where we are today. So one takeaway here is that there is more volatility that the market's pricing in. So is it different than prior years? Yeah, there's some more volatility now than there has been in other Septembers of past, including September of 2016 when we had an election. The other thing that you would note here is 30 days out and 60 days out. This covers this election cycle. The volatility here is higher than the market's basically pricing in increased volatility through the election, and then it tapers off from there. So this is kind of the opposite of what it sets up to historically. So feels different this time. We've had a lot of things happen in 2020 that makes it feel differently, and the markets are pricing in a little bit of increased volatility or increased uncertainty through the election. So if it feels different to you, there's some cause for that, or some backing for that from what the market is doing. So I think it's worth exploring kind of this alternative scenario. We did get one question around this. What happens in the case of a disputed election? This is kind of those three scenarios that we outlined earlier, kind of any way it goes, as long as there's a smooth, normal transition of power, like those things are not super impactful or expected to be super impactful on what the market does. This other scenario, if we have a long, drawn out process, the market is not going to like this uncertainty in the short run. So want to look through what that scenario might look like and wrap up with some investment considerations. So I'll go ahead and pose the question that was actually submitted, because it's related to what we're going to cover here. So basically the question is, with some of the news coming out and some of the headlines, some of the quotes, that there might not be a peaceful transfer of power, that the market could be in for some unprecedented volatility if the election's not decided shortly after the close of the polls. Question, should an investor increase their cash holdings as a response? So let's look at kind of both of those things. What happens if there's not a winner declared or a winner decided shortly after the polls close, and then the investment considerations based on that. So wanted to really just step through an election timeline. I guess one silver lining here of 2020 would be a civics lesson for all of us in terms of how elections go. November 3rd, general election day. Everybody probably has that date on the calendar. The timeline from there, and obviously this is one of the things that could delay a result this year, is the increased number of mail-in balloting. So in Oregon, we've been doing mail-in ballots for a while. Typically those things are counted pretty quickly, but states that are doing this for maybe the first time might not be able to count the ballots as quickly. There are some pretty major swing states. I think Michigan, Wisconsin, and Pennsylvania would be three that I believe state law doesn't actually allow them to start counting those ballots until the polls are closed. So there probably will, I mean, it would be unlikely, unless there's a big landslide one way or the other, that we're going to know the results of the elections at the end of November 3rd. It's probably going to be a period of time where the ballots have to get counted. So the period between, this is for this year, November 4th and December 14th, is allowed for counting the popular vote. The key date here is December 8th, which is a safe harbor deadline. Basically, the states have control over the election process in their states up until November 8th. It's known as a safe harbor. They're given that time to basically certify the results of the election and determine who wins the electoral votes for the state. On November 8th, if a state cannot determine who has won the state, Congress has the ability to step in and get involved and do that. This year by December 14th, the electoral college votes should be determined. So that's kind of that first initial timeline. I think both sides are kind of forecasting a bit of a legal fight over the results, and some will be challenged and things like that. Most of those, it seems, would probably happen during this period, this initial period. On December 14th, the electoral college votes are supposed to be assigned and allocated. Kind of the next key date here is January 6th, where Congress meets to actually essentially certify the votes that they're received, the electoral votes, and basically say, yes, we accept these. So the first piece there is, the states, it's up to the states to be able to certify the votes of their in their state. And it's actually on the state legislature to do that. It's not up to the governor, it's up to the legislature. So that's kind of the first thing. Then Congress has the ability to essentially challenge any member of the Senate or the House from any given state can challenge the results from that state. And so there's another ability for Congress to act. And if that happens, both houses basically go to their chambers and decide if they want to certify the vote or not. Both houses have to agree to basically a recount or some other measure to decide the outcome. If both houses do not agree, basically the challenge is null and that the results are accepted. So that's kind of the second hurdle. The third hurdle would be if at that point there still isn't a 271 electoral votes to win the election. If that still isn't determined, the House actually gets to vote, and that vote is done. So kind of the final step is Congress could actually step in and decide the next president. It's a vote among states. Each state gets their own vote, one vote per state. So California has the same number of votes as, I don't know, Wyoming or North Dakota or some less populated state. So each state would have one vote, and it's basically up to the party that would have more seats in the House at that point. So it'd probably be a vote among party lines at that point. So that's kind of the process here. So I think from a market perspective, the longer this thing goes on, the more uncertainty and volatility that there's going to be. However, kind of the comforting fact for me is twofold. One, there is a process to deal with this, to dealing with a disputed election. And then two, it was nice to see today many people coming out and saying, there will be senators and congressmen, there will be a smooth transition of power. So that's obviously what we want, and the best thing that can happen is a smooth transition of power. And the next best thing from a market perspective is the sooner we know, the better. Other thing to note is we have gone through a couple of these scenarios before. So the two key elections that we've basically tested this timeline in the past is one, the 2000 election, the hanging Chad debate, and Bush versus Gore. That one was settled before this December 14th date. Basically, the Supreme Court stepped in, made a ruling that the votes as counted in Florida would be accepted, and no one in Congress challenged that. So the electoral votes were assigned to Bush, and that pushed him over the threshold to win, and the rest of this process went smoothly. Back in 1876, I believe, Rutherford B. Hayes versus Samuel Tilden actually went to that final step where it was decided by Congress. And this was a really interesting time in the country. It was not long after the Civil War. So we had Lincoln assassinated, went to Andrew Johnson, who was finished out Lincoln's term. Ulysses S. Grant served for 2 terms. And then after that was the election of 1876. So very contentious time, economic issues. This is during Reconstruction, a lot of turmoil in the country. And it actually went to this place of making it to Congress, and Congress essentially voting, and Rutherford B. Hayes won as part of that. There was a little bit of deal making in that. There was an agreement for Union troops to pull out of the South and kind of roll back some of the Reconstruction policies, which ultimately wasn't a good thing, but that was the agreement to have the Republicans win that election with Rutherford B. Hayes. So two times in our history, we've actually tested this timeline. 2 times it's worked, and interesting to basically see how these things have played out through 2 historical examples. So key things here are, there is a process in place, and there are some key dates that, we can be watching, and the sooner that this gets wrapped up, the better. Investment considerations of this, and again, the question was, should an investor increase their holdings to cash as a response to this? So the first thing that I would encourage anyone to do, basically to that question of increase the holdings of cash, is how much cash or bonds or things that shouldn't fluctuate in value a whole lot are you holding currently? So say you're spending 5% out of your portfolio every year, and maybe you have 40% in bonds. That should roughly, do the calculation, that should be about 8 years of spending that you have set aside. So question would be, you know, do you need to increase your holdings more than that? It's really hard, especially in a volatile market like it's probably going to be over this period. It's going to be really hard to time the market. So, you know, don't make a decision from a market timing perspective. Make a decision more from, you know, are you comfortable with the amount of spending or accessible money that you're holding? That would be the first thing to consider. Kind of along those lines, an investment writer, Morgan Housel, who I read a lot, has a line that says you should save like a pessimist, but invest like an optimist. So think about that bucket of, that's your pessimist bucket. How much do you want to have in that bucket? But your money that's invested in the market for growth should be your optimistic bucket. So basically have enough in that bucket that where you're a pessimist, that you don't have to touch the money in your bucket where you're an optimist, would be another way to think about that. If you do, however, don't feel comfortable with that amount, you want to make a change to your risk tolerance, I would say sooner is better than later. You don't want this to be an emotional driven decision. You don't want to do it after the election, based on the outcome or based on the lack of an outcome. I mean, now would be the time to revisit that if you don't feel comfortable with the amount that you have there. So that'd be the second thing. International diversification. Obviously, if you are a client or if you've read some of the other stuff we've done or watched any of these videos that we've done, you know we're a proponent of international diversification. And I think, you know, this is one of those scenarios of why. Not having all your eggs in one basket that are tied to one particular country, the politics in that country, or other economic factors in the country. So that'd be the third consideration. Don't forget about international diversification during this period. The last question we get is around hedging. You know, should I hedge my portfolio through this period? And the only thing I would say here is it's expensive. Typically, hedging, you know, options, puts would be the way that you would hedge this. They're tied to volatility. So as volatility goes up, it gets more expensive to hedge this. So just to give you an example, on $1 million portfolio to hedge a 10% drop in the market through the election is going to cost about $43,000, which is roughly, you know, 4.3% of that $1 million. So pretty expensive, 4.3% to hedge the portfolio if it doesn't work out like the way, you know, if you don't benefit from that trade. So that just a couple things to think about there. How many years of spending? Do you need to make a change? Consider that sooner than later. Be diversified, and you know, hedging feels good. You're going to feel protected, but it's an expensive thing to do. So if you want to talk further about any of these things, you know, obviously let us know, get in touch, and we'll be happy to continue the conversation and address those specifically in your circumstances. Okay. Again, we are to the Q&A section. So if you have any questions, make sure to send them in now. I'm going to go ahead and address the other question that we did receive with registration, which is around tax platforms of the different candidates. And this one came in towards the end, I believe. And so I apologize, a lot of detail here. It kind of goes into the, didn't have time to write a shorter letter to that quote, but kind of the key differences between the two candidates' proposals. And again, one thing that I would consider you to think about is a campaign policy or campaign rhetoric is not policy. You know, you have to get approved. Sometimes these things get pulled back a little bit, but these are the tax plans as the candidates have laid them out to date. So individual taxes from Biden's plan, these go up at least the top tax rate. So currently it's 37%, which was down from 39.6 before the Tax Cut Act. The proposal there would be to put it back to the 39.6% for people with taxable incomes above $400,000. Trump's plan is to keep the 37% and potentially implement a 10% tax cut for middle income, lowering that rate. On the deduction front for individuals, Biden's proposal is to limit the deductions to 28% rate. So if your tax rate is above 28%, essentially you're not getting the full value of any deductions that you're taking. You know, they're capped at that 28% tax level. Only thing on Trump, you know, no changes, but potentially the itemized deduction policy right now is set to expire in 2025. And so potentially that would be extended. Capital gains and income here under the Biden plan for incomes above $1 million, basically the preferential capital gains tax rate would go away. So if you're above $1 million, capital gains would be treated as income. So subject to that 39.6% tax rate. So that's a pretty big jump up from the 20% that is the top capital gains tax rate now. Obviously, capital gains can be timed somewhat. You're able to choose when you're going to sell an investment potentially. And so these things could be spread out over a period of years or something like that. But that is a significant, if that becomes law, that would be something significant to make sure to at least plan for as part of your financial plan. Individual tax credits here under Biden potentially increase the individual tax credits up to $8,000 or $16,000 for two children or more. That'd be a significant tax credit. And then on the corporate side, so here, right now, the tax rate is 21%. And so a talk about increasing that in addition to putting in potentially a minimum tax there. So tax rates potentially going up on the corporate side as well. So that's kind of a overview. There's a few other details in some of these plans, but it's kind of an overview of the two. Obviously, when a president's elected, new tax policy doesn't go into place immediately. So these things need to be debated, discussed, approved, etc. And so it gives us time to plan, but does mean something we need to keep an eye on, and potential changes or timing of realizing income or capital gains or something like that being done as well. So that's it there. Coming up on time, it looks like, and it doesn't look like any other questions have been submitted. If you do have any questions, make sure to submit them now, and we can go ahead and address them. If something that you want to discuss or follow up later, let us know, and we can do that as well. So that's it for today. Thanks again. Oh, it looks like we got one question coming in. I'll go ahead and take time to answer this one. Okay, so this is a question about health information coming in. CDC publicly admitted the health death count does not differentiate between died with or because of. What would that do to the market? So question is about health data. Potentially, are some of the numbers overstated, and what would that do? I think this falls into the camp of one, probably some of these numbers are on the margin, and so it's not going to skew the total numbers a whole lot. But second would be, ultimately this is good news. If the virus is less deadly or less people have it than expected, ultimately that's going to be a good thing for the market. I think one of the keys from a market perspective is how does the economy stay open and grow and rebound from here. So kind of the better the health data that we get, the more that's going to help with the market and help with economic growth from here. So that's how I would answer that one or see that one. So that's it. Thanks again for submitting questions ahead of time and in the presentation. If you have any additional questions, feel free to let us know and we'll follow up with that. These are posted on cordantwealth.com/23-10. So if you want to view the replay or share it with somebody else, you're free to do that. And that's it. Thanks for attending, and we'll see you next month. Bye.